No, thanks very much, Lisa. And this is actually, the topic is timelier, more timely than I had realized, than I had expected, because if you watch interest rates, as you know, rates are very low today, but still they have moved up quite a bit since last year. So bonds which were sold last year, many of them are selling at some discounts, and they are candidates for tax loss harvesting. It turns out that the tax loss harvesting of munis is surprisingly complex relative to equity. And just to introduce this to you and to make you aware of what's going on, I have a very simple example. Suppose that you purchased a bond 2 years ago, not over a year ago, for par, and this bond now has 8 years remaining to maturity. And what I'm showing here is, what if you sold it? You bought it at par, so if you sell it below par, you take a loss. If you sell it at 99, you have a 1-point loss. It's a long-term capital loss, capital gain, capital loss. The applicable tax rate is 20%, so you save 20 cents per dollar, per $100. But look at the right-hand column, which shows the tax, which shows the actual benefit, not just taxes, but the value of this transaction. It's much less than 20 cents. It's only 3 cents. And even more surprising, if you sell the bond at 96, now you have a 4-point loss. So you save in taxes 80 cents. But the benefit is actually negative. You lose half a point. So how could this happen? What's going on here? If any of you understand what's going on, you can skip kind of the first few slides here. If you don't see what's going on, you will understand it. It will be crystal clear, and it's surprising. Let me just add that I assume here that the bond was purchased more than a year ago, so the applicable tax rate is the long-term rate, which is 20%. Had you purchased the same bond within the past year at par, the tax rate would be the short-term rate, which is twice as high, it's about 40%. So then the tax savings would be, in the first case, would be twice as much, 40 cents, and the benefit would increase by 20 cents. And in the second case, the savings would be 1.6 points, and that would put the benefit, make it positive. So short-term, I'm emphasizing that short-term losses are much more important than long-term losses. Now, but please, how come that the benefit is actually so little? It's so much less than the tax savings. We should not be focusing on the tax savings. We have to focus on the benefit of the transactions. And unfortunately, many people who are involved in tax loss harvesting are just looking at the savings and without any regard to the benefit. That's okay, I think, when you're dealing with equity, but when it comes to munis, things are much more complicated. So let me give you questions.
Yes. Short-term capital losses are offset against gains. And so if you're offsetting a short-term gain, then yes, you are getting the benefit of the higher tax rate. But if it offsets a long-term capital gain, then basically you're just avoiding the tax on at the 20% rate on the gain. So it's actually quite complicated. If it's trying to offset ordinary income, you can only do that up to, I believe, $3,000 a year. So that so it's of limited value in offsetting ordinary income.
You're absolutely right. That's absolutely correct. And for convenience, I assume that you are offsetting short-term gains or long-term gains, depending what it is. But of course, in practice, it's a critical issue. And if you don't have offsetting long-term short-term gains, then of course it wouldn't be so valuable. I mentioned that later on, but that's a very important point, and the offsets are critical to the profitability of these transactions. Absolutely. Now, let me give you the agenda. So the key points. So first and foremost, to appreciate what's going on, you have to recognize that the market prices of munis are affected by the tax which is payable by the buyer. I'll elaborate on that. But that's very, very important, because if the buyer has to pay taxes, then indirectly when you sell, you are paying for that tax. There's something called the de minimis threshold. You may not have heard of this. I'll just tell you what it is. It's basically what's a small, it has to do with small discounts versus large discount. The critical point is de minimis. So I'll tell you what it is. It's 1/4 times the number of years remaining to maturity. So if the bond has 10 years to maturity, then you multiply that with a quarter, that's 2.5. The de minimis discount is 100 minus 92.5, which is 97.5. So if you buy the bond at 97.5 or above, the applicable tax rate turns out to be the capital gains rate. But if you buy it below 97.5, as you will see shortly, the tax rate is much higher. The applicable tax rate is much higher. And I'll show you. Yes.
And the question, the first bullet point, right? What you're alluding to there is the fact that if I want to dispose of a muni bond prior to maturity, I'm subject to the fact that and rates have gone up. I'm subject to the fact that the new buyer will pay me a little bit less because of the fact they have to make up they have to basically recognize a gain when they pay less than whatever amount for the bond from me, right?
Exactly,
so,
Leon, that's the point. You got it. And I'm going to give you examples, but that is precisely the point, that a new buyer has to pay tax.
Right.
While you, if you are holding the bond, may not have to pay tax. And that brings me to my second point about hold value, which is worth how much is the bond worth to you? But that depends on how much you paid for it.
Right.
Way back, and whether or not you have tax obligations due to your purchase price some time ago. So that depends on the investor. It's this hold value, which is a critical concept for munis. It's a critical concept for anything, but it's very important for munis. It's investor specific. It depends when you bought the bond, how much you paid for it, and it may substantially differ from the market price. So just to clarify, there's only one market price, but there are all kinds of values depending on who is holding the bond and how much the person paid for the bond. Very important concept, critical concept. Okay, another concept I just want to mention, you may be familiar with it. I refer to it as resetting the short-term clock. Simply, I talk about short-term versus long-term capital losses. And if you have held the bond for over a year, you cannot take a short-term loss. So it may make sense to simply sell the bond and repurchase it, even if it perhaps hasn't lost value. And you can do it, it's not even a wash sale, and you reset the short-term clock. And then things get more interesting, the tax option. So the point is that this tax loss harvesting actually is an option exercise. And this is the more interesting part of my presentation, I hope. So this option is acquired whenever you buy a security for a taxable account. You get it automatically. It's an option. The option is to take advantage of tax beneficial sales subsequently. Also, it doesn't cost anything. You have it whether or not you want it, whether or not you want to use it. You have this tax option. And then something very important when you think about a dynamic investment strategy, So when you sell a bond, you exercise an option, but then you reinvest and you pick up another option. So selling and reinvesting entails the swap of tax options. And this is very important in determining the optimum time of when to transact. And then the final thing is, when should you transact? What is the right time to transact? Well, you can optimize that. There's a notion called, I call it tax efficiency. And it says, how much do I save versus how much do I give up? And the idea is that to exercise the option to take advantage of tax beneficial sale opportunities only if you extract, if the tax efficiency is at 100% or very close to it. So that's the agenda. These are the points I'd like to discuss. Now, again, just to clarify, as indicated at the bottom, what do you want to do? You want to do better than just simply buying a holding. And also, although you cannot repurchase the same bond, you can buy many bonds which are similar to what you have sold. And if you want to do, you can maintain your risk exposure. Incidentally, for those of you who are not familiar with the Muni market, there are probably there's in excess of 1.2 million individual securities. So there's a lot to choose from. Okay, unless you have other questions, let me push on and demonstrate some of these ideas. First of all, the tax treatment. Let's understand what's going on. So it depends whether you bought a Muni above par or below par. If you buy a Muni above par, what you have to do is amortize the premium down to par, either at maturity or if it's callable as of the call date. And so this determines the tax basis. And if you happen to sell the bond at this point, then the appropriate tax basis is this point. Something to keep in mind, just for future references, is that if you buy a Muni and hold it to maturity, you never have tax savings at maturity because of this amortization feature. That's easy enough. But the point is, if you bought it at this point up here, and then you sell it somewhere later on, then the relevant point is the, for tax purposes, is the amortized value. Okay, clear enough. Now,
so while it's amortizing, then you can take the amortization as a deduction against the interest income, correct?
I don't think you can. I don't think you can.
It can't just disappear. It's
not. It doesn't. You can't. I don't believe so, John.
You can with so you certainly can with a taxable bond.
But this is not. It's
and
different.
I believe there's an exception where you have tax exempt.
Yeah, because the 5%, the premium is treated somehow. The higher coupon is considered to be tax. That's not taxable, and that this compensates for the higher coupon that's not taxable.
Yeah, so you would be able to take a deduction, but it's not allowed in this case because
there's a broad principle called the tax benefit rule, where you do not get a tax benefit if the offsetting income or gain isn't subject to tax. It's very pervasive. And I believe there's also a special statutory provision in this case that disallows the amortizable bond premium deduction.
But I think, guys, question, if I have a taxable bond, right, that I bought at a premium, I amortize down the basis, right? If I don't sell the bond, right, that capital loss due to amortization cannot be used as an adjustment to my coupon income. If I hold a bond, if I'm a retail investor, I can't take a mark-to-market loss if I haven't sold the asset. Isn't that correct?
It's not mark-to-market, but there's a formula constant yield to maturity deduction, just as there is original issue discount and market discount. You compute a constant yield
Right.
Okay, and that determines the amount of income you actually take.
Oh, I see. In other words, it's coupon income minus the drop in value due to the amortization based on constant yield calculation.
Based on constant yield. So it's not true mark to market, but it's a kind of formula.
Yes, I see what you mean. Okay, right.
All right.
Thank you.
I'll keep it to munis, actually, and I'm not that familiar with taxable, with the tax treatment of taxable bonds. Keep in mind that munis are always held in taxable accounts. It's a very important point. And that's what enables us to come up with some very good formulations for valuing municipal bonds. Taxable bonds are held by all kinds of investors, mostly in pre-tax accounts. Munis are held in after-tax accounts.
Actually, some pension funds hold munis. I've never really got it.
It doesn't make much sense. They do it for speculative. You're right.
Yeah.
I mean, I'm exaggerating a little bit, but generally, you show me somebody who's not taxable, who's holding munis, and I can suggest a trade, which would be probably preferable. Anyway, let's go to the discounts, and this is the important part. And now you will understand what's happening to these discounts one that I showed earlier. So if you buy a muni at a discount, you have this accrued market discount, but the important part is that gain is taxed at maturity, and as I mentioned, depending on whether it is large gain or small gain, it is taxed as, if it's small, it's taxed as long-term capital gains. If it's large, it's critical. It is taxed as ordinary income. Taxed as ordinary income, which is about 40%. And this is the very important feature of discount municipal bonds. These are not OIDs, by the way. They assume that they were issued above par. All right. So let me show you now some. I set the stage here for the tax treatment, and let me show you some exhibits in a moment. But how do you analyze munis? First, I'd like to make some points. You have to use what's called option-adjusted spread analysis. And for those of you who work in fixed income, you have heard about it. Others may not have. By the way, we mentioned the Salomon brothers earlier. The term was invented by a colleague of ours in the Muni, in the mortgage area, OAS.
Lou Ranieri, perhaps?
No, not Lou. No, not Lou. Lou would not do it. No, Mike Waldman.
Ah, okay.
He was doing research. No, not Lou. But we didn't invent the approach at Salomon, but the terminology comes from there. Anyway, so there's this OAS, which is very standard. You find it in every introductory fixed income book now. My favorite is Stockman's book on fixed income securities, but it doesn't work for munis because it doesn't have taxes. So when you have taxes, the way I have, which I have shown you, have to be adjusted, which I have just shown you, they exist and they are important. You have to incorporate that in the analytical framework. So there's this tax neutral option adjusted spread analysis, which is what I came up with 7 years ago or so. And that's the appropriate framework. And it's being used by some big players, including, Lisa, we spoke about BlackRock. BlackRock has licensed this tax neutral OAS methodology. So there are two key concepts: the tax neutral price, the tax neutral fair value, which is the present value of the after-tax cash flows, at the given discount rates, which you get from some yield curve. And just to give you some idea, I'll do it very quickly. How do you calculate the after-tax cash flows? Let's just assume that we're dealing with an optionless bond. With call options, it's more complicated. But the idea is first you discount the cash flows, and then you say, okay, here's a price. So on this price, I have to pay some tax. And then you say, then you have to subtract that tax from the terminal price, from the par at maturity. So you don't get 100, you get only 95 or whatever the tax is. But then when you discount that number, you get a lower price, so you pay even more tax. So that's why you have to have this iterative calculation. It's not rocket science because it converges, but I'm trying to give you some flavor of how to value tax-exempt bonds, and how you can see how taxes had a very interesting dimension to all the analysis. It's like suddenly you see in a different color, you see more dimensionality, much more interesting than if you don't have taxes. So anyway.
Now hold on a sec. You're making some, you're idealizing this a bit. You're not taking into account, for example, estimated taxes. You could.
No, you're right. I'm doing it, but there's pretty extensive literature. I can send you a paper which shows that when you look at the secondary market prices of these discount bonds, there's an implied tax rate. And so it turns out that this fits when you do this tax neutral valuation, the way I have described it, and you put in the implied tax rates about 40%, you're going to get sensible prices. But if you don't put it in, you don't get sensible prices.
After-tax discount rates.
Yeah.
Right.
The discount rates come from, I'll talk about it, but you have yield curves like anywhere else.
But you have to tax it. You have to tax adjust them. You can't use pre-tax discount rates to discount after-tax cash flows.
Sure, the municipal discount rates are pre-tax. They are low, but they are pre-tax.
You use a Muni discount curve.
You use a Muni discount rate,
okay.
Absolutely. Of course, everything is in Munis. I'm not even looking at treasuries. I'm looking at Muni discount rates. Good point. I should have mentioned that, of course.
Because most people derive, when they say discount rates, it's derived from swap curves. But in this case, it's derived from the Muni market itself.
No, it's all Munis. And Munis have their own world and their own terminology. I mean, if I just said one more thing, kind of a bit tangential, I don't know if you know how many of you realize that the standard benchmark Muni curve is represented by the yields of 5% bonds, which is callable at par in year 10. And that's the benchmark yield curve. And you have to convert that callable curve into optionless par rates or optionless discount rates to do all this. I'm not going to spend time on this today, but I'll be happy to elaborate afterwards, if you have any question. So yes, it is the Muni rates.
Thank you.
Okay, great, good point. So let me show you now some more interesting things. So just pretend that rates are 3%, and I'm looking at 10-year bonds with coupons below 3%. And the question is, how much are they worth? Well, if you do it pre-tax, just discount using 3%, you get this line, the green line. But if you take into account this tax at maturity at 40% tax rate or so, which is a good number, then you get a much lower line, the red line, which is the correct one. And you can see this huge difference between the pre-tax value and the tax-adjusted value. Look at it, 2.5. It's 96.5 versus 93 3/4. And again, the important part, this is the market level. So tax at maturity depresses the prices of discount munis by a large amount. Now, let's talk about this hold value, which is so important. How much is the bond worth? I'm showing you 3 lines. This is the same market price line that you saw just now. Same bond, 3% bond, same coupons. The green line is something else. It's not it turns out to be the same as the pre-tax value if the bond was purchased above par, because you're discounting the same flows and there's no tax at maturity. So the green line represents the hold values of these bonds with various coupons, assuming that they were purchased above par. But if the holder happened to have bought the same bond at 90, for the sake of argument, then there's a payment on taxes, there's a payment on a 10-point gain at maturity, that's 4 points, and that depresses the price. And that's a green line. So I'm just emphasizing that the hold value depends on when the bond was purchased and how much the buyer bought. All right? Any questions? No, okay, great. So let's go on. And now let's look at this notion of how much is what's the benefit of us from the sale? I showed you some in my first slide where you saw the benefit wasn't as large as you expected. Well, the benefit is the after-tax proceeds, sales price plus tax savings, minus hold value. Just look at the difference. And that's what it is. It's cash flow. Now, to estimate this hold value, it's a bit tricky. You have to use the market price to get the discount rates, but the hold value and the market price can differ, as I have just shown you. So, and how do you estimate the hold value? You use this stack neutral option adjusted spread analysis. I won't get into it, but I hope I've given you a flavor of what's going on. So that's the benefit, very simple calculation. What is remarkable, when you talk to these registered investment advisors, and how they look at it, they say, oh, they think about this cash tax loss selling as a swap of selling a bond and buying one, and they immediately start talking about the replacement bond. But you realize that the cash flow benefit does not depend on the replacement bond. So they make this analysis incredibly complicated, and it's wrong. The replacement bond has nothing to do with the savings. However, the replacement bond is needed, as you will see, to calculate option values later on, the tax option values. So I just want to tell you that. But it is not needed for savings. And it is just confusing to talk about what do I buy when I sell this bond. Those are two different decisions.
Andy, could I ask a question, please?
Sure, go ahead, Leon.
Yeah, so Andy, so in this top formula, okay, so the after-tax proceeds, that's affected by the fact that the price that the new buyer will pay is depressed, right, by that effect, right?
If you buy a discount,
yeah,
absolutely.
yeah. So in other words, so let's say, look, go back to your first page, right? When the buyer pays 90, let's say, he's adjusted, that price is lower than it would be precisely because they'll have to pay it. They're subject to a tax, right, as it rolls up to par, right?
Right.
Whereas the hold value doesn't have that effect, right? Because it's the value of the original holder, right?
If you bought it above par, there is no tax effect. If you bought it at a discount,
so is it correct to say that this difference, you said, going back to your page 1, why the benefit was so small, even though the nominally, you saved, whatever the tax benefit was, 20% of the, 20%.
No, I get your point. Yes, exactly. The benefit
is it purely from the fact that you've got these two different values, the value to the new buyer? That's the reason why the benefit was only 3 cents, even though the how much you could adjust on your tax you paid was 20 cents. Is that right?
Exactly, you got it. That's exactly what's going on. I emphasize that you bought that bond at par.
The first buyer,
yes,
right.
Exactly,
right.
Exactly.
So it's purely, in other words, the origin is the effect of that when you try to exit the bond, you're subject to this lower price because of this effect. you've talked about,
Yes,
essentially.
yes, exactly.
Okay.
Okay. So,
Sorry, just to be clear on that, because I think that is a key point. You're subject to this lower price because you have to take the price that a buyer who's subject to this new tax cost will pay you. And that
is
depresses the
100%
price.
correct. That is exactly the point. You are prepaying the tax of the buyer. Exactly. And if you got it, I think my presentation has already been a success, because that's the key point. That's a key point. Exactly. That's exactly right. But so here's an example. I'll give you a quick example just to speed up a little bit, just to how it works. Just repeating. Suppose you bought a bond 2 years ago at par. So your basis is 100. You're selling it for 97 today. You have a 3-point loss. At a 20% tax rate, you have you save 60 cents. So your after-tax proceeds is 97.6, but your hold value is 98.1. So you're actually losing. You saved a lot you have a big loss, but the transaction is also losing money. It's the same point that I made earlier, but just demonstrates the flows. Okay, let me go on. And now the more interesting part comes. So first of all, you have to decide, does it make sense to sell? Is it beneficial? And you say, yes, it is. You decided. But now the option valuation comes in. Should I do it now or should I do it later? It may be more beneficial later. So this decision of do it now or do it later, it's an option exercise, and we have to value the tax option and determine the optimum exercise of an option. And this is intellectually much more interesting, much more challenging. So let's talk about the tax option, and I'm repeating some of the things I said at the introduction. It is investor specific, and John made the point about the offsetting gain, which is very important. Transaction costs are important. They also have to be incorporated. We spoke about short-term losses versus in the future versus long-term gains. I don't want to belabor that point. But here's something which is really important. When you reinvest, you sell, you have proceeds, now you reinvest, and you pick up more optionality. And that affects the optimum timing of the sale. Again, I mentioned at the very beginning, you reset the short-term clock, which gives you an incentive to transact earlier, because the same bond, if you can take a short-term loss, is more valuable than if you cannot take a short-term loss. We spoke about preserving the risk profile. So in any case, this tax option, how much is it worth? Given the framework I described, you can value it using this tax-neutral OAS framework. And you have to worry about interest rate volatility. This is not the volatility of the tax-exempt yield curve, not the treasuries or the swaps or the LIBOR curve. You have to worry about transaction costs, bid-ask spread, but the computers can do this.
So, Andy, so that profile of the market value, the price to be paid by the new buyer, right, as a function of the coupon of the bond, right, that graph, right, that's assuming a constant OAS assumption, right?
Yes.
You basically sort of say, the bond pays a 2.5% coupon. What would this bond trade at in a 3% yield, 3% tax-exempt yield environment with 2.5 coupon, or let's say a 2% coupon? Those two prices would give me the same tax-neutral OAS.
Yeah. Actually, in that example, I have 0 OAS, just discounted 2.5% bonds.
But it's constant OAS. Yeah,
it's constant. You don't even look, this OAS, to understand this concept, you don't need to talk about OAS. If you have optionless bonds, all you have to do is discount and see for yourself what's happening. I don't mean to make it more complicated, than it needs to be.
But you have this exaggerated price loss due to the extra tax.
Yeah, it's all about the extra tax. Yes.
Yeah, right.
Yeah, but the price is what it is, and then you have to deal with that price. So this is a tax option. And now here comes something very interesting. How do you decide when to sell? So there's a lot of academic literature about option valuation, but there's very little about optimum option exercise. And it may be assumed that, gee, it's just so simple. No, it's not simple. It's very complicated, particularly if you cannot observe a market price associated with that option. How do you determine when to exercise it? So anyway, you value the option somehow. And here's this notion of tax efficiency, which is just a ratio. You decide what the cash flow benefit is. I have shown it to you. And then you say, what did I give up in option value? But it's a net loss because you give up an in-the-money option, and then you acquire another option, which is at the money. And you look at the difference between the two. And this is the formula. I'll give you, take just a minute and tell you a little bit of background about this formula. Where does it come from? I've done a lot of work on refunding, bond refunding, optimum bond calling. And how do you determine what's the optimum time to call a bond? Well, the optimum time to call a bond, or the so-called call efficiency, is based on cash flow savings, interest savings, if you like, divided by the forfeited option value. And you want to be close to 100%. But in many cases, I'll give you an example, the refunding bond, when you refund, you automatically get another option. And the example for that is a residential mortgage. Suppose you refinance your mortgage. So you get some cash flow savings, but when you refi, like it or not, your new mortgage is also immediately refinanceable. So you have to look at, you have to incorporate this new option into the refunding decision, the refinancing decision. And we came up, there's actually a paper that I co-authored with Dean Yang and Frank Fabozzi about what we call generalized refunding efficiency, which is this formula, except here you have refunding efficiency or refinancing efficiency on the left, and here you have the net loss of call option value, not tax option, but refunding option. So this is kind of interesting, and you want to act when you're close to 100% efficiency in refunding. Okay, so let me go on and give you an example of this. The example comes actually from the following exhibit that you will see momentarily. How does this work? Okay, so here's an example. You have a bond, 3% bond, 8 years to maturity. It was purchased and sold above par. I'll show you the assumptions momentarily, but the point is you have some small savings from the transaction. You give up 0.54. You receive a reinvestment, assuming you buy back the same bond, which you cannot do as a practical matter, but you can buy something similar. 0.36. So you got 0.14. You gave a 0.18, and you have 78% efficiency. That's how the calculation works. Now, let me show you what can be done and what should be done, and I hope what will be done shortly. Here's an example of what a manager can do, somebody who's managing the funds of a client. And just to show you what happens, so suppose the client has 3 bonds. One of them is this 3% bond that I have just shown, the first one. And it was purchased at some date, at some price, in 15 at 110. Currently, the basis is 108.22. You remember I showed you that slide about amortization. Note, however, the date is old, 17. So here's the basis, here's the sale price, and you calculate the savings, you calculate the score, which happens to be 77.8%, and it says, you know, it's really not so great. It's maybe you want to wait. The 2.5% bonds, which were bought at par and trading at 97, not surprisingly, you lose on them, even though you have a large tax loss. This is what you saw on the first slide. On the other hand, if you bought a bond at a high premium, 115, the basis now is 113. If you can sell it at 111, you save a lot, and you should transact today. And this should be done every evening. The analysis could be done every evening based on the closing prices of bonds, and then every morning the manager can look at an exhibit such as this and decide what's a good candidate for tax loss harvesting. Again, it's not just the savings, it's also all this optionality. So let me wrap up with a couple of exhibits related to this. One, it turns out that some bonds are much better suited for tax loss harvesting than others. You have already seen that these bonds at par are not very good. It's because of this de minimis business. But if you buy a bond at a high premium, and many bonds, most muni bonds are sold today with 5% coupon. So there are lots and lots of bonds that come way above par, and it's a 10-year bond. And the embedded tax optionality is about 2.6 points if exercised properly, assuming an interest rate volatility of 15%, which is low by today's standards. The muni vols are closer to 30% today. And annually, you can pick up about 30 points, expected to be able to pick up on the average. Or you can buy a deep discount, and even that's not too bad. Par bonds are not very good, but these are savings under proper potential increase of return under optimum management. What happens in practice? I have already made some comments about it. But you need to do this tax loss harvesting from munis. You need to be able to estimate the tax effect of sale, the cash flow benefit. You have to know the hold value. And ideally, you should know the value of the tax options, which I think is a bit, today is pie in the sky, but it can be done under. And what's available? You talk to investment banks, not investment bank, but wealth management systems. And you'll correct me if I'm mistaken, but none of them have ever heard of hold value or the tax option value. And the wealth managers focus on savings. And they assume that if you save a lot, it's going to be a good sale. The sale is beneficial. And it's not true. And try to explain it to them, this notion of a hold value. They never heard of hold value. So all they see is, gee, I bought this at 100, now it's 90, I can save 10 points. I can sell it at a 10-point loss. I save 4 points in tax. Look how great it is. Never realizing that they are actually losing money on the trade. So that's what I have seen in terms of wealth management systems. Major platforms, you look at them. I won't name them. I don't have to name them. They don't have anything. I spoke to one major, somebody from salesman from a major platform, and I said, "What do you have for after-tax calculation?" He said, "Oh yeah, we know how to do it. We can calculate after-tax purchase yield of a discount." I said, "You know, that's a yield to maturity calculation. That doesn't do anything for you." They don't realize it. I think it's coming, but it's coming slowly. But to do this correctly, you need tax-neutral OAS, and you have to understand the concepts that I have just described. So just to summarize, I showed you that if you manage an intermediate duration portfolio, you can increase expected return by 20 to 30 basis points by picking up the right bonds and selling them at the right time. What should you be buying? I mentioned before, repeating myself, you should buy bonds selling well above par. Those are the best ones. What should you not buy? You shouldn't buy bonds selling near par, because you won't be able to, if they go to a discount, you get this tax effect and the price is depressed, so you won't be able to sell them economically. When should you sell? Use the tax efficiency. That's my recommendation, at least. So I'll mention to you a few papers if you have any interest in this. So again, to value these bonds, you need tax neutral OAS, which is described in this article that I published in the Journal of Investment Management, the tax neutral valuation. Just earlier this year, I co-authored a paper with Guy Davidson, who used to run the Munis at Alliance Bernstein. And this makes the same point, that these par Munis are not suitable for investment portfolios which are marked to market, because they are going to be underperforming. Same notion. But it's kind of understood by managers, but you need tax neutral analytics to make it rigorous. For tax loss harvesting, again, there are lots of papers on tax loss harvesting, but not too many on bonds, and I'm not sure that anybody there's much about munis beside what I have written. The paper I recommend is the Tax Efficient Trading of Municipal Bonds, which talks about the notion that when you sell and reinvest, you're swapping tax options. And there's another article. The Muni yield curve, it's a mystery to many. It should be. It's 5% coupons callable at the bonds are callable at par. So the yield of a 30-year bond is the yield to call in year 10. It's not really a 30-year yield. How do you get 30-year yield? That's a whole other interesting question. Let me just add one more point. I don't know if Wujin sent you. I'm publishing this book on the interest rate risk management of municipal bonds, and I discuss in detail the yield curve issue and also the valuation. How do you value them correctly? Okay, just a couple of more things. There are some, if you're interested in tax loss harvesting, we have a demo, Muni Signal, at our website, kalotay.com, live. You don't have to sign in or anything. You can use it. Also, the Muni OS demo, which demonstrates the tax neutral valuation. So you see what happens when a bond is trading above par or below par, and you can see the wrong answer based on analytics that don't capture the tax effect. There are also a couple of demos, speed demos, that you might find interesting, which show how long it takes to value bond portfolios. And you may, if you're not familiar with bonds and bond analytics, you'll be surprised that you can value 1 million bonds in 1 million callable bonds under a minute in a low-end computer, if you know what you're doing. So you may have some fun with those. That's what I have. If you have any questions, I'll try to answer.
Andy, I may have asked you this question before, but this fact, you've explained this to me in the past, that the impact of this depressed price on the part of the new buyer, right, exaggerates the duration, creates like a negative convexity effect when rates go up, right? It pushes down the price. I mean, if you were to do empirical analysis, if you can, of how muni prices have responded to yield moves, right? Is like the regression, does the regression bear out the fact that this extension of the duration, so to speak?
Absolutely, and in-house. So what Leon is referring to, yeah, he just stated. So first of all, the duration of these discount munis is much longer than you would assume it is based on standard duration analysis. Why? Because if rates go higher, the price drops. But when the price drops, there is the taxes increase, so the price drops even more. So just to give you some idea of what we're talking about numerically, today a 10-year treasury bond has a duration of about roughly 9 years. A 10-year muni at a discount, if you value it wrongly using standard OAS has a duration of 9 years. If you do it correctly, it's about 13.5 to 14 years. You missed by 50%.
It's
staggering. Absolutely astonishing.
It really is staggering.
It is staggering. It's staggering, and people are using these. It's in my book that I just mentioned, this risk management. I talk about it. The option-adjusted spread is similar because what you see every time munis fall to a discount, some fall to a discount, you see something in the press, munis are cheap, discount munis are cheap. No, they are not cheap. They're not cheap. The prices are depressed, but if you buy them, you have to pay tax. So again, the OAS, the spread is overestimated in this case by 30 to 40 basis points easily. This is a real problem for the industry, and sooner or later, proper analytics will have to be applied. It hasn't been a big issue because muni rates have been so low recently, particularly during the past year, but it's changing.
Barron's had a piece this last weekend from some asset managers saying that he thinks that there's significant value in high yield munis. Seem to be offered pretty good risk return. I don't remember the rationale.
Well, I can't speak about it. I mean, the default rate historically, this is a different topic. The municipal default rate has been much, much lower than corporates, but it has increased quite a bit. And you hear about Puerto Rico, you hear about Illinois and Chicago, which are in pretty bad shape, but still the overall, there haven't been too many defaults in munis. And everybody's looking for yield. So what do you do?
I have a question, Andy. In the equity space, when we talk about loss harvesting, it's very often in the context of an index and with risk minimization and doing harvesting losses in many securities over time, as opposed to the one at a time analysis that you've given here. And I'm wondering if there's any analog in bond space. There are muni indexes and so on.
Lisa, I talked to managers, and all I can tell you, these are pretty well established people in the field, and all I can tell you is what I have learned from them, how they look at it. And they look at it as, first of all, these munis that where they want to harvest are typically in separately managed accounts. And they are looking at it as one-on-one. I sell this and then I buy this. And that's it. And I don't understand. It really is, in my opinion, way too simplified. We should think about this whole tax loss harvesting as selling a portfolio of bonds and replacing it with another portfolio just to begin with. But that's not how it's done.
Well,
so I'm still learning this.
I think I can speak to that a little bit.
Okay, please.
Debt is different from equity, and it's hard to replace Exxon with Total and be comfortable that you have the same exposure. So therefore, it's very attractive to replace whole indices where you avoid the 1031 limits, the limit on short sales in this context, but really do replicate exposure. Now in bond land, you can sell a bond of one LA county and replace it with a bond of a Bay Area county and get really very similar exposure. So that the tremendous advantage enjoyed by indices in the equity space because of the fundamental differences between different securities and the very high volatility are not present with the same gravity in bond space. So you can just do one swap for one and be comfortable that you've replicated your exposure.
What Nicholas says is exactly what I hear. Again, I'm not involved in actual management of these portfolios. People are using our analytics, but this is precisely how it's being done.
So I had a question about building a muni yield curve, and it has two pieces. One is that in order to build a yield curve, you have to be able to go short in order to get forward rates. And shorting in the muni markets is fairly expensive. You'd mentioned a 50 basis point bid ask, which seems significant. So it's also possible to finance a muni bond position with taxable debt in certain ways. You can't do it one for one because of the straightforward deduction disallowance. And of course, taxable debt is cheaper after tax than shorting muni debt because the muni coupon represents a sharing of the tax advantage with the issuer. Whereas you get 100% of the tax advantage if you borrow on a taxable basis. So I wondered if your yield curve, muni yield curve construction considered the possibility of using taxable debt to build it. I'm guessing it didn't.
No, but it's a great question. I'll tell you something. Last week, I got a call from Frank Fabozzi because he told me that he is going to include a chapter on municipal bonds in the next edition of his book on, I'm sure you're familiar with, on fixed income securities. And he asked me specifically about the hedging of munis. Well, I told him that there are two basic issues. One, as you know, you cannot even short munis. That's the first point. And then secondly, we have this problem with the muni yield curve that in terms of coming up with a hedging instrument, with a muni derivative, how do you do it if you don't have a live yield curve? That's a whole other issue.
Yeah.
So you're touching up on some really delicate problems. But the way I am involved, my consideration is muni yield curves. I mentioned to you that, for those of you who didn't know, that the standard muni yield curve is a 5% non-call 10 curve. And the reason for that is because the standard munis are 5% non-call 10 bonds. But it is changing now because of the 2017 Tax Act, which is a completely different story. And so there's more and more issuance of munis with, say, 4% coupon callable in 8 years. And the question comes up, how do you compare these two? How do you know what, as long as everything is 5% non-call 10, the pricing of these bonds is pretty simple. But once you change the lockout or change the coupon, you need analytics and you need a real optionless curve. How do you get it if you starting curve, the benchmark is callable? So that's where I'm coming from, rather than the hedging of asset portfolios.
But Andy, if you had, let's say, actively traded muni bonds across maturities, all of which had callability, right? Can't you, through some bootstrap mechanism, extract, assuming you're given a volatility, extract an optimalist curve from that?
Yes, that's what we do. And it's in that paper that, hang on, I go up once. I discuss it in this paper, creating a live yield curve. Look at the Journal of Fixed Income.
Right.
But one of the big questions is, what is the volatility to bootstrap? And so I mentioned to you, remember there was an exhibit and it showed 15% vol, and I made the point that 15% is too low. Today, the vol is somewhere between 30 and 40%. But how do you know what it is? And if you talk to the typical muni manager and you ask them, hey, what's the volatility of the market? They don't even know what you're talking about.
Well, what they might say is that this is very silly, but what they might say is Munis is trading 89% of treasuries, right? So I'll scale the implied volatility by 0.89 to reflect the fact that with the trading level. But I know that sounds crazy, but they would probably do that. Yeah.
But they don't even do that anymore because the 10-year muni rate, AAA muni rate, is higher.
Yeah, now.
Than the 10-year treasury, which is 155 or so now.
Right.
So it's very difficult to go back and forth between treasuries and munis. In fact, the interesting part, in my opinion, I'm going to say something that I have said to several of my friends in muni land. What we should be doing is comparing taxable munis to tax-exempt munis. So today, I don't know if you realize, about 30% of the munis are taxable. Why is that? If you're interested, I have a paper coming out on this in the next issue of the Municipal Finance Journal. They are used for refunding not yet callable muni bonds. And so now we have this very rich information about taxable munis. And we should be, when we talk about implied tax rate, we should look at the taxable munis versus the tax exempt munis, and not at the treasuries where I think we all agree that the treasury yields are artificial today.
So it used to be the case that the long end of the curve provided a much greater share of the tax benefit to investors, because most investors wanted a shorter yield. And of course, municipalities would love to lock in financing for 30 years or longer. That's the nature of their needs. And they want to match fund their long-term projects with long-term debt, but it's expensive. So they have to give up a tremendous amount of the tax value on the long end. And so there was a rich muni swap market, taxable, of course, that would let issuers on the one hand, or investors on the one hand, get that tax benefit out to 30 years, get that share of the tax value, and swap it into a floating rate. And conversely, for issuers, that's also an indication of a curve out there. And it'd be interesting to see how that compares with this new expansion of taxable muni debt. I haven't looked at it in decades.
Let me make one point, and I may not be answering your question, but I have been very critical of the practices in the debt management side of munis. I'm very critical of these taxable advance refundings. They are extremely wasteful. In my opinion, they have already cost tens of billions of dollars to the taxpayers of the municipalities who do it. I was even more critical of the use of swaps to convert floating rate munis into fixed rate munis. I actually testified at an SEC hearing about this. I testified that these swaps cost municipalities, they were overcharged. Municipalities were overcharged on these swaps to the tune of over $20 billion. They are doing all kinds of fancy stuff because this is the issuers, because they listen to investment banking proposals. I don't blame the investment banks. I blame the advisors who are supposed to protect the issuers, and they do a very poor service, in my opinion. Every municipal issuer has a so-called municipal advisor who helps with these transactions. And those advisors, by and large, are extremely poorly trained, and they don't stand up. They don't do a professional job when they have to respond to these investment banking proposals.
Well, supporting the international markets through continued high level of investment banking fees has, of course, been a fundamental policy of finance worldwide. It's hard to recruit and compensate adequate municipal advisors when the competition is so well funded and so well connected.
Well, let me make one comment. I don't mean to go off in a tangent, but until 2012 or 11 or so, until Dodd-Frank, municipal advisors were not regulated. They were not certified. As a result of Dodd-Frank, municipal advisors today are certified, and I happen to be on the committee of the MSRB, which developed the certification process. And I made the point then that the certification process was completely inadequate. They don't discuss options. They don't do valuation. I'll tell you one thing. If you are familiar with the GFOA, the Government Finance Officers Association, which represents all municipal issuers, they have best practice, and you can read that, best practices for refunding. And I looked at it recently on the best practices for refunding, which has to do with advanced refunding and calling mostly now. They mention savings, I think 27 times. They mention option value 0 times. And this tells you everything you need to know. And this is the industry. And in my opinion, the MSRB is responsible for this mess because they don't adequately regulate the industry, the advisors. But we're getting off the main topic. Dan, you must have some idea, question. Good to see you.
I just had one quick question. Have you given any, because you and I have talked about this, have you given any thought to the issue of mixed portfolios where you have muni bonds and equities in one portfolio? Because obviously the capital gain effects can go across both depending on what you're doing in your portfolio. And if you think about most high net worth individuals, they're probably going to own both. They're not going to own one to the exclusion of the other.
But then we spoke about this, and you're making a good point that, I mean, they don't necessarily have to be in the same portfolio, but the two portfolios should be under the oversight of the same person somehow. That's the point. That's the critical part. Right. Absolutely. And I don't understand why the logistics are so complicated. Absolutely. It's so essential.
Yeah.
Because typically,
I mean, one of the oddities is.
I don't know. Lisa might be able to speak about
this. Yeah, I mean, one of the oddities I can tell you, I can think of one very large firm that does a lot of tax loss harvesting in equities, but just can't do it in fixed income simply because they have a FIFO accounting system. They don't actually keep the data in a form in terms of cost basis and so forth that would allow them to do optimal trading of fixed income.
But then how do they report how do they report to their clients how much they owe in taxes then? They don't track that.
Well, they have it they have it apparently for, you know, the end of the year. Somehow they get it for the end of the year, depending on what transactions do or don't occur, but they don't actually, you know,
track I see
it
what you mean.
day to
okay.
day.
Right. Understood. Yes. Right.
And, you know, so you can't use it as sort of an ex ante mechanism for making choices.
I see what you mean. Right.
And, you know, I've talked to Andy before about this and, you know, we've tried to sort of coordinate a little bit because obviously we have what we think are good ways of dealing with the equities. And I've certainly read all of Andy's papers in the past about how to do it with fixed income, but I haven't had any success in talking to actual wealth management clients and saying, you really ought to take advantage of the fact that yields are going to be going up. So you're going to have capital losses on the fixed income side, offset gains on the equity side, if in fact they occur. That's so far a bridge too far.
In 2021, I find this amazing. I really do. What is the problem?
Presumably this is in the hands of the wealth manager, right? Who's overseeing the after-tax asset allocation. I mean, there's always this tension between individual experts and aggregating up. And it's very tempting to say that everything should be looked at from a common perspective. And it's right in an ideal world, but I think it's harder to do well than it maybe sounds. And even without considering taxes, even for an institutional investor, right? There's still big funds and they outsource to get some sort of expertise. And then those experts don't see the big picture. Or think about it when you're in your health, right? You have specialists that are looking at your foot or your gallbladder or something and use your whole body. I mean, it's always this tension between that, but there are obvious benefits between seeing the things from a common vantage point, no question. Do we have any more questions or comments on this very interesting talk?
Well, thanks very much, Lisa. I hope I've told you a few things that you hadn't heard before.
Oh, this is great. I'm still interested in my index question, but wonder if it's just like doesn't work there, or if there's an opportunity that nobody's paying attention to. But it's another subject for another day. So thanks very much, Andrew. Can we post the slides?
Absolutely. And Woojin has I sent Woojin the slides.
Wonderful. So
you're welcome to please call if you have any questions. Do give a try to those demos at our website, because you'll find them interesting. You put in a bond, you can specify bonds, and you can see what the savings are, what the tax option is. You can have some fun with those calculators.
Okay, well, we sure will. So you'll be finding the slides and I guess also the recording on the CDAR website. And next week at the regular time, we have a paper called the Popularity Asset Pricing Model. I think Tom Azarik's going to be talking on joint work with Roger Ibbotson and Paul Kaplan. So look forward to seeing many of you next week. And till then, stay safe out there.